So hello, what's up? How is everyone doing? Welcome to this revision of group audit. Before we begin this revision, let me tell you, sir, where will we find this board notes? These board notes you will find on the Telegram channel. The link is in the description. So download these board notes and enjoy this revision. In this revision, we are not only going to cover the concepts, but also the amazing questions of ICI that have been asked in the previous exams, RTPs and MTPs. So without much ado, let's begin with this revision. The first topic that we studied in group audit, or you can also call it audit of CFS, a very important topic. 5 marks expectation you can have in your exam, a very simple and scoring topic. So the first topic that we studied was, why do we need to prepare the CFS? Is it compulsory? And if we need to prepare, what are the provisions applicable to it? So everyone please focus on the board. It says, whenever there is a company which has one or more SAJVs, sir, SAJV means subsidiary, associate, or joint venture, then, sir, it needs to prepare the CFS. Now, how to prepare the CFS? The provisions related to PA. PA means preparation, adoption, and audit of the parent company will apply mutatis mutandis to the CFS. That means they will apply as it is to the CFS. Now, sir, what do you mean by adoption? Adoption means approval. CFS will also be approved by the board of director and laid in the AGM along with the SFS. Also, you need to attach the subsidiary financial statement detail in the form AOC1, can be asked from MCQ point of view. Now talking about the preparation, like every financial statements, they are also prepared as per Schedule 3 and accounting standard. Accounting standard means example Ind AS 110, 111 and 28. Now, if the company is exempt to prepare the CFS as per AS, still it needs to comply with the Schedule 3 ka disclosure requirement. Same thing is given in your notes. Let's revise it from the notes. Revision in the revision. Let's see what it says. Whenever the company has one or more subsidiaries, including the associate joint venture, it needs to prepare the CFS of the company and all its subsidiary. How to prepare it? The provisions of PA. PA means preparation, adoption and audit. Come on. Preparation, adoption and audit of the holding company will apply mutatis mutandis to the CFS. Now, sir, let's talk about the adoption. Approved by the board of directors and laid before the AGM along with the SFS. Along with it, attach the statement of the features of subsidiaries FS in the form AOC1. How to prepare it? As per the Schedule 3 and applicable accounting standard. And if the company is not required to prepare CFS, that means it is exempt. Still, it needs to comply with the Schedule 3 ka disclosure. Are the basics of law clear? Yes, sir. Now, sir, we move to the next topic, which talked about exemption from CFS. Now, sir, what do you mean by exemption? 60 and above. No, sir, we are not talking about that exemption. Exemption from CFS. So in the FR, Ind AS wala part, you have covered these exemptions already. Let's cover it from audit point of view. Let's say there are 4 companies: ultimate holding, intermediary holding, holding and subsidiary. We are focusing on this company, that how it can get exemption from preparing CFS even after holding a subsidiary. Okay, sir. So let's say the intermediary holding has 80% share and 20% is with other members, that is the NCI. If 3 conditions are fulfilled, then holding company does not need to prepare the CFS. Condition number 1. All its other members, that is the NCI, they have been informed in writing that company will not prepare the CFS. We have the proof of delivery that they have been informed, plus they have no objection to the same. Second thing, even the public does not worry because the company is not listed, neither it is in the process of listing. And the third thing is, either the intermediary holding company or ultimate holding company, they are preparing the CFS. So because they are preparing the CFS, they are already getting covered. So they are preparing the CFS and filing with ROC as per the accounting standard. So if they are doing it, again, you don't need to prepare the CFS. So these 3 conditions need to be fulfilled. The second exemption from CFS, investment entity like mutual fund. If they are measuring the investments on FVTPL basis, FVTPL means fair value through PNL. Any increase in fair value credited to the PNL. Any reduction in fair value credited to the PNL. Then again, it does not need to prepare the consolidated financial statement. Now, sir, what are the 3 conditions for investment entity? It is obtaining the funds for providing investment management services. That means investing the money in different shares. Now, how does it measure the returns? Returns are from capital appreciation, that means share price increase, investment income, dividend, or both. And lastly, measure the performance on fair value basis, not on cost basis. If these three conditions are fulfilled, company does not need to prepare the consolidated financial statement. Now, sir, one question. If there is a holding company of an investment entity, does it need to prepare the CFS? Yes, unless it is also a investment entity. Are the basics still here clear to all of you? Yes, sir. So with this, if you come to the question bank, the basic question of provisions of Companies Act for preparation of consolidation, this is done. Also the cases where the CFS is not applicable, this question is also done. You can take a read of this question. Okay, sir. Now comes question number 2A we will cover later on. Please come to question number 3. Let's do the question number 3. Question number 3 says Advik Investment is a company having a paid up capital of 1 crore and it has a subsidiary Investor Fund Management Limited. Major business of Advik Investment is to pool money from the investors and invest this money in various funds. Company has pooled 10 crore from a number of clients which represent the company shareholder. While auditing the books, you observe that the whole amount of 12 crore, I think it should be 10 crore only, it has been invested in the shares and debentures of various company and profit is earned through appreciation of these shares and distributed to the shareholder of the company. Performance is measured on fair value basis. So CA Chirag raised an issue that while auditing the FS of Advik Investment, whether CFS are required or not. So logically tell me, are they providing investment management services? Yes, sir. Now they are earning the money through capital appreciation and investment income. And the third thing, their investments are valued on fair value basis. Can I say all the three conditions of investment company are fulfilled? Yes, sir. So do you think Advik Investment needs to prepare the CFS? Answer is no. So you just need to mention the three conditions of investment entity. Then say investment entity not required to prepare the CFS. But if there is a parent of investment entity, it will prepare the consolidation unless it is also investment entity. So lastly, just write Advik is not required to consolidate as per section 129 subsection 3. So this is a revision of RTP MTP May 25 question. Done. Now after this question, you can try question 3B. It is a similar question and you will enjoy it. Okay, sir. Now after this, come with me. Let's understand two exemptions. Two exemptions which are given in AS 21 but not in Ind AS 110. What are these exemptions? Let's understand. First of all, exemption from temporary control. Let's say if I acquired a control in a subsidiary and the next year I sell the shares and the control is gone. So if within that 1 year the control is gone, can I say it is a temporary control? Yes, sir. So for temporary control as per AS 21, you don't need to prepare the CFS. Second thing, if let's say the holding company is not able to get the funds from subsidiary due to any reason, that means there is severe LTFTR. LTFTR means long-term fund transfer restriction. So when the subsidiary is not able to transfer the funds, can I say the control is not in the hands of parent? Yes, sir. So whenever the parent is under severe LTFTR, what is LTFTR? Long-term fund transfer restriction. Again, as per AS 21, CFS is not required to be prepared. In both the cases, Ind AS 110 has no exemption. Ind AS 110 says clearly, the moment you acquire the control, you need to prepare the CFS till the date the control is there. Okay, sir. Now everyone, please come to the question. Please come to your notes. And in the notes, let's discuss about this example given in the material. Sir, what does this example says? Everyone see with me. Parent Limited acquired 51% shares of Child Limited during the year ended 31st March 24. Now in the next year, 20% shares were sold. So if out of 51%, 20% will be sold. Can I say control is gone? Yes, sir, control is gone. So for the year ended 31st March 24 and 31st March 25, it did not consider the financial statement of Child Limited for consolidation. How will you deal with it? So you just need to mention as per Ind AS 110, there is no exemption for temporary control or LTFTR, long-term fund transfer restriction, and consolidation is mandatory. Then add just extra point. Sir, what is the extra point? that whenever a company has subsidiary and it is not required to prepare CFS, still you need to comply with Schedule 3. Then just write the facts of the case in 1 or 2 lines, and conclusion is company is required to prepare the CFS. Sir, for what? 31st March 24. Because the control was taken for the year ended 31st March 24, it should prepare the CFS for 31st March 24 because the exemption is not available, and consolidation begin the day investor gets control. And when does the consolidation ends? When the investor loses the control. Okay, sir. On this concept you can practice question number which, sir? Question number 2. I think you can practice question 2A and 2B. So chalo 2B you do, question 2A let us revise it together. Question 2A says R Limited owns 51% voting power in S Limited. It holds and discloses all the share as stock in trade. Whenever I say stock in trade, can I say it is a temporary control? Yes, sir. Today it is a control, tomorrow it will be sold. Since the shares are held with a view to subsequent disposal in the near future, R Limited represents that while preparing CFS, S Limited should be excluded from consolidation. How will you deal with the same? So please tell me, when we are solving the question, what approach you need to follow, AS or Ind AS? Sir, Ind AS. And in Ind AS, no such exemption is available. So similarly, you will attempt your answer. As per Ind AS 110, no exemption for temporary control or operation under severe LTFTR, long-term fund transfer restriction. Consolidation is mandatory. Then write consolidation begins from the date you obtain the control and cease when the control is gone. Then, sir, write the facts of the case and conclusion. R Limited is required to prepare CFS as per Ind AS 110. Are the basics of consolidation clear? Come on, everyone. Yes, sir. So till now, in the last 10 minutes, 11 minutes, we have just covered the basics of consolidation that you have already studied in FR. But yes, these are relevant from audit point of view. Are these basics clear? Yes, sir. Now let's begin with the next topic. And the next topic talks about responsibility of the parent. So till now, whenever we talk about responsibility of the management, we say PPFS, preparation and presentation of financial statement. Now we will say PPCFS, preparation and presentation of consolidated financial statement. So logically tell me, how are the CFS prepared? Sir, very simple. First of all, identify the components. Components means SAJV, subsidiary, associate, joint venture. So identify the component and obtain the information from them. Acha, can I mix my information and component information as it is? No. You need to do consolidation adjustments. Give me example of 2 consolidation adjustment. Harmonization of accounting policy. That means subsidiaries accounting policy should be as per the parent before consolidation. Okay, sir. And the second thing is gap adjustment. Gap adjustment means if the parent's financial statements are as per Ind AS, subsidiaries financial statement should also be as per Ind AS. So you need to make sure the gap of both the financial statement should be same. So these are the same points given. Just go in the flow. So we need to prepare the CFS. For that, identify the components and financial information. Once you have identified, obtain complete and accurate. Come on. Complete and accurate financial information from component. Once you have the information, make the consolidation adjustments. Consolidation adjustment, to example, gap conversion and harmonization of accounting policy. These are the same points given here. Along with it, additionally, 2 more points to remember. Identify reportable segments for segment reporting as per Ind AS 108. Related party and related party transaction for reporting as per Ind AS 24. So these 2 Ind AS you ignore in FR, but very important 5 marker question can come in FR. Okay? So remember it from audit point of view also. Then just read this part. Parent generally issues the instructions to the management of component specifying what financial information they need for CFS. This will cover the accounting policies, disclosures, segment reporting and related party reporting along with the timetable. Is the responsibility of parent wala part clear? Yes, sir. There is a direct question on this part in your question bank which says responsibility of the holding company for preparing CFS, asked in RTP November 21, so can be asked in your exam also. Direct question. Sir, students can get confused. How? Responsibility for the holding company. Why are we not writing about the Companies Act wala points that we discussed in the beginning of the revision? They have not asked about it. Unless they mention Companies Act requirement, you will not mention about it. You will mention the 5 steps that I have taught you. Okay? Okay, sir. Now let's move to the next topic. Everyone come with me. Auditor objective in the audit of CFS. First of all, tell me what is the overall objective? Sir, we need RA means reasonable assurance that the financial statement as a whole are free from material misstatement, whether due to fraud or error. Then we can express the opinion that the financial statements are prepared in all material respects as per the applicable FRF. Do you understand these basics? Yes, sir. SA 200, Inter. So these are the things you need to consider while framing this answer. So we need a reasonable assurance that financial statement don't have material misstatement so that we can give our opinion that they are prepared as per applicable FRF. Same way you need to write this answer. Satisfy means reasonable assurance that the CFS are prepared as per applicable FRF. If they are prepared as per applicable FRF, you can give your opinion that they give a true and fair view of the CFS. Okay? Okay, sir. Now, sir, to do this, you need to do company law 2 sections. 143.1, 143.3. 143.1 requires you to inquire about certain matters. Laws and advances, book entries, sale of shares and securities less than the cost, deposits, personal expenses, and shares issued for cash. Okay. If you want after this revision, you can revise the company law part also. Okay, sir. Then it is requiring you to report on the matters of 143.3. A long list is given of 10 matters. Okay, sir. And lastly, just validate whether you need to prepare the CFS or you are exempted from CFS. So simple answer, satisfy, give the opinion. 143.1, 143.3, and lastly, validate the requirement. Is everything till here clear? Yes, sir. Then we have a topic, you just need to read this topic. Nothing critical in this topic. Okay? Do it in a very fast manner. Whenever you want to prepare the CFS, what do you need? Parent ka SFS and component ka SFS and apply the procedure as per the applicable FRF. Sometimes for the component SFS, you can use the work of other auditor unless you are also the auditor of the component. CFS are prepared using the SFS of the parent and component plus some other information. What is the other information? Disclosures, items for which different accounting policies are applied as per AS 21. Or adjustments for significant transactions between the financial statement of parent and component. So this other information needs to be disclosed. Now, sir, you need to assess whether alone you can express the opinion. If you feel alone is not enough, you can use the work of other auditor. Other auditor means the auditor of the component or the auditor specifically appointed for assisting you in preparation of in the audit of CFS. So this part you just need to take a read conceptually. That's it. Now comes a very important topic. 5-star topic of the day, audit considerations about materiality. Please tell me, those who have already covered the lectures. In the audit of CFS, what are the 2 types of materiality computed? Sir, first of all, the materiality for the whole CFS. Then the materiality for the individual material components. First of all, the materiality for the whole group, whole CFS. Then the materiality for the individual components. So please look at the board. We draw a very amazing chart. So the first thing is audit of SFS. It's a simple. For each component on standalone basis, you compute the materiality. S1 ka different materiality, S2 ka different materiality. Then for audit of CFS, you need to compute 2 types of materiality. Group materiality and materiality for each material component. Okay, sir. So group materiality has 2 uses. Audit the consolidation adjustments and determine the material components in the group, because they will become a part of your scope and there you may use the work of other auditor. Now for these material component, you compute the separate materiality. So compute the materiality of each component and communicate to the component auditor. Now when you are communicating, also take a confirmation that the other auditor is independent and has complied with ethics. Are these 4 points clear? Yes, sir. Last time revise Mindni. For separate financial statement, materiality on standalone basis. For CFS, 2 levels of materiality, group materiality, 2 uses. Audit the consolidation adjustments and identify which components are material so that I can focus them. they can become a part of my scope of audit of CFS. Now for the material components, compute the materiality for each component and communicate to the component auditor. When I am communicating, what is the additional thing I need to ask? Hello, component auditor, are you independent? Very good. Have you complied with the ethical requirements? Confidentiality, objectivity, integrity, professional competence, you have professional behavior. Okay. You also need to take a confirmation for independence, ethics, and etc. Got it? Got it, sir. Then we covered a very amazing point. When you are considering the observations, observations means modified opinion, EOM para, OM para, in the component audit report, you need to consider the materiality as per SA 600. Sir, materiality means, please understand, CFS revenue 10,000 crore, group materiality at 5% is 500 crore. Now, in the subsidiary audit report, there is a modified opinion because of a material misstatement of 120 crore. Now, this material misstatement of 120 crore, is it material for the group? No, sir. In the CFS, do I need to modify the report? No, sir. Because group materiality is 500 crore and from the point of view of the group, 120 crore is immaterial. Okay. So you don't need to modify the group audit report. With this, the materiality wala part is done. Then, sir, we covered very small topics. Everyone, please focus. Planning the audit of CFS. When I say planning the audit of CFS, just revise the general planning. What do you plan? Sir, nature, timing, and extent of audit procedure. Two types of procedure: risk assessment procedure, further audit procedure. Risk assessment procedure talks about, oh my God. Risk assessment procedure talks about understanding so that you can identify and assess the risk of material misstatement. Further audit procedure talks about whatever risk you have assessed, to respond to that risk, you need to do the extra procedure. These are called testing procedure, test of control, substantive procedure. Now, sir, using this understanding, just frame the answer with me. First of all, we will do the understanding procedure. Understand the gap. Gap means G for group structure and group wide controls to prepare the CFS. AP means accounting policy of the parent, component and consolidation process so that you can harmonize all of them. After understanding, you move to further audit procedure. That means nature, timing and extent of further audit procedure. That is the audit procedure based on assessed risk of material misstatement. Please tell me, what is the good news? Good news, good news, good news. What is the good news? Sir, the good news is we don't have to do all the testing ourselves. Some testing we will do, some testing other auditor will do. Some testing will be done by the subsidiary ka auditor. So the next point says extent of the use of other auditor work. Now when I'm using the work of other auditor, I will have to coordinate with him. So logically there are only 3 points. Understand the gap, nature, timing and extent of other procedure based on risk assessment. The last 2 point talks about the good news. That means using the work of other auditor and coordinating the work to be performed. Clear, boss? Clear, sir. This question has already been asked in Jan 21, so can be asked in the exam. And the last thing that we covered before the break, how the auditor ensures completeness of the components in the CFS. Sir, completeness means how do you ensure that all the components have become a part of CFS? Sir, very easy. Just see your previous year working paper. In the previous year working paper, whatever components are there, they should be a part of CFS. So review the working paper of prior year for the known components. Okay, sir. This is my work. What about the parent work? So review the parent's procedure for identification of component and then ask them whether any new component has been added or any component has gone out of the CFS. Then do the basic procedure. Components are what? My investments. Review the investments of the parent and the components to determine the shareholding. Then joint venture, joint arrangements and other arrangements not included in CFS. So these 3 basic points you can cover. Clear, boss? Clear, sir. Then we discussed the FR wala topic, our favorite topic. Consolidation process as per AS or Ind AS. Subsidiary mein what you need to do? So line by line basis mein we just need to add the items. Their asset, my asset, add it. Their liability, my liability, add it. Their income, my income, add it. Their expense, my income, add it. Now when you are doing the consolidation, calculate the goodwill or capital reserve along with the minority interest in case of AS 21. What is the other thing? Eliminate the intergroup transaction or intra-group transaction. Sir, eliminate the intra-group transaction. So whatever are the transaction between the parent and the component, eliminate them. So eliminate the intra-group transactions, balances and unrealized profits as per AS 21. Then we discussed about associate. For that, use equity method as per AS 23, and joint venture may, because you don't have the whole control, you have a joint control. So whatever is your proportionate control, just proportionately consolidate. Okay. Okay, sir. Similarly, as per Ind AS, again line by line basis pe add the assets, liabilities, income, expense, cash flow. Here we compute the goodwill or capital reserve, also called as GBP, gain on bargain purchase, and NCI, non-controlling interest. Eliminate the intragroup transaction balances, unrealized profits, and when you eliminate, it leads to deferred tax as per Ind AS 110. Similarly, for associates and joint venture, equity method as per Ind AS 28. For joint operation, you need to prepare the separate financial statement and just include your share of joint operation as per Ind AS 111. Common control method is called pooling of interest method, and business combination in stages, which is called step acquisition. What do we need to do? Sir, remeasure the previously held equity interest. When you remeasure it at fair value on the acquisition date, it will lead to some gain or loss, which need to be set off in the PNL or OCI. Okay, so this is what you need to do. Then we understood the concept of de facto control. When you have less than 51% of the voting rights, still you have the ability to control and direct the activities. Then, sir, it is a de facto control. Okay, sir. Now, sir, on this part, consolidation process, I think we did a question. Question number 9. What happened in question number 9? Sir, question number 9 mein what he did, there were so many components: subsidiary, joint venture, associate, common control, and joint operation. For all the component, they applied line by line basis of accounting. So they started adding the items on line by line basis. So line by line basis is applicable for subsidiary, not for others. So for joint venture and associate, as per the Ind AS, it should have been equity method. For common control, it should have been pooling of interest method. For joint operation, Ind AS 111 should have been applied. So this is what you need to write in your answer. Okay, sir. Then after this, what we did, sir, we understood the consolidation adjustments. So the first consolidation adjustment we understood with the help of this example. Whenever you acquire any entity, you calculate the goodwill and NCI. So goodwill calculation and NCI calculation, these are what? Permanent consolidation adjustment. So these are calculated on the date of acquisition or whenever there is a change in the shareholding. So please look at your book. Very easy points. Permanent consolidation adjustments are the adjustments made on the first occasion or subsequently whenever there is a change in the shareholding. So if your share in the subsidiary has gone from 80% to 90% or 80% to 60%, it will lead to a change in NCI, and this is a permanent consolidation adjustment. Now, sir, goodwill or capital reserve is a permanent consolidation adjustment. Minority or NCI calculation is a permanent consolidation adjustment. What do we need to verify? Sir, we need to verify the net assets, or you can say pre-acquisition reserve. For this, you should know the date of acquisition. If you know the date of acquisition, calculate the identifiable net assets or pre-acquisition reserves and divide it between the parent and the NCI. This is the same thing given here. They should be properly allocated between the parent and NCI. And lastly, changes in the consolidation adjustment due to subsequent acquisition or disposal of the component. So if the share has gone from 70 to 55%, it will lead to an increase in the NCI. Okay, boss. Okay, sir. Then we understood another concept. Sir, what was the concept? Let's say there is a goodwill of 800 and capital reserve of 600 for one subsidiary and another subsidiary. Can I show a net of 200? Yes, you can show a net of 200 goodwill in the balance sheet. But sir, in the notes to accounts, you need to show that there is a goodwill of 800 and capital reserve of 600 and net balance of 200 will be shown. Okay, sir. So Baba, with this permanent consolidation adjustments is done. After this, we covered current period consolidation adjustment. Is this a new topic or a revision of FR? Sir, this is also a revision of FR. First of all, it says whatever are the intra-group indebtedness, eliminate. On that indebtedness, whatever interest you have received or paid, eliminate. Whenever there is an intra-group transfer of assets and there is an unrealized profit on the asset, eliminate. When you eliminate the unrealized profit, it leads to deferred tax as per Ind AS 12. Then sir, we have already covered harmonization of accounting policy. And after this, come on, where the point? Gap adjustment. So if it is a foreign component, conversion from the local gap to the gap in which parents' financial statements are prepared. Then sir, NCI calculation, movement in the NCI is also a current period consolidation adjustment. Now sir, in the Ind AS, NCI can have a negative balance because if the subsidiary has a negative net worth, NCI can have a deficit balance. Then we covered a special type of transaction. MCQ can be asked on this part. Everyone please focus. Sir, what? Let's say CFS are prepared on 31st March 25. Components balance sheet is prepared on 31st December. So can I consolidate the components balance sheet with my CFS? Yes, you can do that. But sir, there is a date gap. It is 31st December. This is 31st March. It is allowed. If it is as per AS, gap is allowed up to 6 months. If it is as per Ind AS, gap is allowed as per 3 months. Now, sir, in this time period, whatever are the significant events and transaction in the component, that needs to be adjusted for CFS. That needs to be adjusted for CFS. So this is what is given here. Significant event or transaction between the date of component balance sheet not recognized and the group CFS when the components FS are not drawn up to the same balance sheet date as parent. And whatever are subsequent events, you can adjust them. So out of all these, even if you are able to remember 5 to 6 points, that are more than enough. So mostly points are elimination, harmonization of accounting policy, gap adjustment, subsequent events, and significant events and transaction. Okay, sir. Then we discussed about this topic of memorandum records. Those who have covered the topic with me, come on everyone. New topic or repetition? Sir, a repetition. You can see the 5 points which are easily repeated. Intra-group transactions eliminated. Memorandum records is just a working of the CFS. So what adjustment entries you will see? Intra-group transactions eliminated. Harmonization of accounting policy. Gap adjustment again. NCI calculation, permanent consolidation adjustment, and deferred tax due to the elimination of P&L on intra-group transaction. So these are the 5 points that you can easily cover here. Now, sir, sometimes it is impracticable to harmonize the accounting policy. So for that also you need to give the disclosure as per AS 21, but this thing is not allowed as per Ind AS 110. As per Ind AS 110, you need to adjust the accounting policy. And lastly, one more point we covered here, sir, what? Income and expenses of the subsidiary should be included in CFS from the date you gain the control until the date you cease to control. Then some notes are given from MCQ point of view that we have already covered. Difference between the reporting date of component and the CFS should not be more than 6 months for AS and 3 months for Ind AS. This is the point that we are covering. Okay, sir. And after this, I said goodwill should be tested for impairment loss on every balance sheet date. Lastly, impairment loss in the goodwill when it is determined in foreign currency. So whatever is the loss due to movement in exchange rate, it should be adjusted from currency translation reserve. So let's say there is a goodwill of $100. Earlier the dollar was 90 rupees, then it come out to be 80 rupees. So whenever there is a loss due to the exchange rate, it should be adjusted from FCTR. FCTR is foreign currency translation reserve. Sir, are we sitting in the audit class or FR class? Arey Baba, these small things now you just need to read. Don't need to spend too much time here. Okay. So just remember that whenever there is a loss due to movement in exchange rates, then sir, you need to adjust it from the FCTR reserve. Okay, sir. This MCQ came in my exam. Everyone please see. It says additional disclosure. Additional disclosure in the CFS for the parent and the component. So for all the entities in the CFS, you need to mention the amount of net assets, P&L and OCI, plus their share of net assets in the consolidation, their share of P&L as a percentage of the consolidated P&L, and their share of percentage of OCI as a part of the consolidated OCI. Okay, sir. So with this, the first part of group audit revision is completed. Now let's move on to the second part of the revision. Now, sir, let's begin with the revision part of the last part of this chapter, which talks about reporting. So in the reporting, we have 5 special cases. Case number 1, parent auditor, also the auditor of components. Case number 2, parent auditor, not the auditor of components. Case 3, parent FRF different from the component. Case 4, component not audited, and case number 5, component audited under a different audited framework, under a different auditing framework. So first of all, let's talk about the case number 1 and the easiest case. Parent auditor is also the auditor of component. So this is a normal audit. So in any normal audit, what do you see? That the financial statements are prepared as per the applicable FRF. So you will report whether the consolidated financial statements prepared and presented as per the accounting standard. If not, then for any departure or deviation, consider SA 705, that means modify your opinion. If otherwise everything is all right, express the opinion whether CFS give a true and fair view of the state of affairs for the balance sheet, consolidated P&L and consolidated cash flows of the group. So this is the basic part which is also written in your book. Everyone, let's revise. Report where the procedures for preparation and presentation of CFS as per AS followed. If not, for any departure or deviation, consider SA 705 so that users are aware about such deviation. Give the audit report expressing the opinion whether CFS give a true and fair view of 3 things. What are the 3 things? State of affairs on the balance sheet date, consolidated P&L, the true and fair view of consolidated P&L of the group, and cash flow statement give a true and fair view of the cash flows. So these true and fair view wala points you need to include. Now let's move to the second part of the game. Second part talks about which case? Come on, sir. Principal auditor is reporting on the consolidated financial statement where a component is audited by other auditor. So whenever a component is audited by other auditor, you will use the work of other auditor as per SA 600. This is the first point. Now when you are using the work, you need to mention in the audit report that you need to refer the other auditor's work in the audit report as per SA 706. You need to give a other matter para. So when you are giving a reference, you need to disclose the magnitude, that means the amount of portion of the financial statements which are audited by the another auditor. How to mention this magnitude? This is the fourth point. You can mention the aggregate amounts or a percentage of the total assets representing the balance sheet, revenue representing the P&L, cash flows representing the cash flow statement. These figures should be before consolidation adjustments. These figures should be before the consolidation adjustments. Yes or no? Yes, sir. And lastly, just clarify. Sir, what to clarify? That the reference to the other auditor's work in the audit report, it is not a qualification of opinion, rather indication of divided responsibility between the principal auditor and other auditor. So these are the 5 points you need to cover. Quickly consider this chart. Refer SA 600 using the work of other auditor, mention in the audit report using other matter para, disclose the magnitude of portion audited by another auditor in aggregate amount or percentage basis. Okay, sir. And lastly say, this reference is not a qualification of opinion, rather an indication of divided responsibility between the two auditors. Okay, okay, sir. Now come back to your notes. These are the same things given here. For framing, you should refer this. Consider the requirement of SA 600. As per SA 706, make a reference to the work of other auditor in the audit report on CFS. Disclose clearly the magnitude of portion audited by the other auditor. This should be done by stating the aggregate amount or percentage of the total assets, revenue or cash flows not audited by parent's auditor. These figures should be before giving effect to permanent and current period consolidation adjustments. And lastly, clarify that the reference to other auditor is not a qualification of opinion, rather indication of divided responsibility between the parent auditor and auditor of subsidiaries. Clear, boss? Clear, sir. Now let's move to the next part. Sir, what happens in the next part? A very, very interesting part. Indian companies preparing the CFS as per Ind AS. US subsidiaries preparing the financial statement as per US GAAP. Can I say there is a difference of GAAP? Yes, sir. Now everyone understands we require GAAP conversion. So there are 2 options available. Option number 1. Parent management will do the conversion from US GAAP to the Ind AS. And as a principal auditor, you will audit the conversion adjustments. Or component can prepare the financial statement as per the Ind AS, that means parent's GAAP, using the group accounting manual. Okay, sir, GAM. Now, sir, local auditor will do the audit as per the group accounting manual. And the parent auditor will check whether the group accounting policies are as per the parent's GAAP. Whether the Group's accounting policies are as per the parent's gap. So this will be something checked by the parent auditor. So the game is very simple. Whenever the parent company has the subsidiaries located outside India, they may be having a different accounting framework. So when there is a case, you need to do the gap conversion. Case option number 1, parent management will do the conversion and parent auditor will audit the conversion adjustments. Okay, sir. Or component will prepare the financial statement using GAM. GAM means Group Accounting Manual. Local auditor will audit these financial statement using the Group Accounting Manual, and parent auditor will check whether the group accounting policies are as per the parent's gap. Please come to your notes, come to your notes, come to your notes. Sir, this all thing we covered by the chart? Yes. See, first of all, the introduction part. Parents may have components located in multiple geographies outside India, applying accounting framework different from the parent. Foreign components prepare the financial statement under different FRF, which can be well known like US GAAP or IFRS, or it can be a local GAAP. Local component auditors are not able to report on the financial statements prepared using the parent's gap because of the unfamiliarity with that gap. So you just understand that the gap is different. Now what are the two options? Option number 1, parent management performs the conversion of the component's financial statement to the FRF of the CFS. Okay, sir. And these conversion adjustments are audited by principal auditor. Second option, component can prepare the financial statement as per the parent's accounting policy using GAM, Group Accounting Manual. Local component auditor will audit and issue the report on component financial statement as per the group accounting policy. Parent auditor will check whether the group accounting policies are applicable to the parent. They comply with the gap applicable to the parent. Okay, okay, sir. Now come to case number 4. Sir, what does the case number 4 talks about? Case number 4 says whenever the parent company is in India and it is having subsidiaries across the world, do I need to cover all the subsidiaries as a part of the audit? Yes. These subsidiaries should also be audited under a multi-location group audit. Now the audit of these subsidiaries can be done by the auditor of CFS or the local auditor, but the audit should be done. If audit is not done, you will not have sufficient and appropriate evidence for the amounts of these subsidiaries included in the CFS. So you need to evaluate a possible modification. Now, sir, whether this possible modification will be an actual modification depends whether the amounts are material. So you need to consider qualitative and quantitative factors as per SA 705. So whenever there is a subsidiary which is not audited, evaluate a possible modification considering the qualitative and quantitative factors of SA 705. Come to the notes, come to the notes. Let's see what is given in the notes. Generally, financial statement of all components should be audited or subject to audit procedures as a part of multi-location group audit. This can be done by the auditor of CFS or components auditor. Okay. Where the financial statements of one or more components are unaudited, oh my god, evaluate possible modification because you don't have sufficient and appropriate evidence for the consolidated amounts or balances. So doing this, check whether it is material, evaluate the qualitative and quantitative factors to see the possible effect as per SA 705. Okay, boss. Okay, sir. Now comes the last part. Everyone very happy. What does the last part says? Sir, the last part says now the auditing framework is different. Now the auditing framework is different. See, in the third part, accounting framework was different. In the last part, auditing framework of the other auditor is different. So it says the audit of financial statement or CFS should be done as per Indian GAS. Sir, what is Indian GAS? GAS means generally accepted auditing standards in India. Like you have Indian GAAP, generally accepted accounting principles in India. We have generally accepted auditing standards in India. So if the other auditor is auditing under a different auditing framework, still it should correspond to the Indian GAS. That means it should be similar to the Indian GAS. Now let's read from the book. Audit of CFS including CFS, audit of FS including CFS, performed as per the auditing standards generally accepted in India, that is Indian GAS. To maintain this consistency of the auditing framework and the parent auditor to rely on the work of other auditor, Components financial statement should also be audited under a framework that corresponds. That means it is similar to the Indian gas. We have covered all the cases. Yes, sir, we have covered all the cases. Now, sir, once we are done with these cases, please come to your question bank. Okay. In the question bank, come to question number 2. How was question number 2? Classic question, sir. Classic question given in your test, your understanding of study material. Let's see what it says. 8 subsidiaries in the CFS are audited by other auditor. Oh, this is case number 2. Now they have also given the 8 for these 8 subsidiaries total assets, total revenue and cash outflows. Do you think I will report about this in other matter para? Yes, sir. Ki these assets, revenues and cash flows are audited by someone else. So if there is a problem, go and catch that other auditor. Okay, sir. Then they have mentioned the case number 3. 2 of these subsidiaries are located outside India and the financial statements are prepared as per the accounting principles accepted in their respective country. That means the gap is different. And lastly, they are audited by the other auditor under the auditing standards of these countries. That means auditing standards are also different. So where and how such information will be included in the audit report? Draft a suitable para. So first of all, let's cover the case number 2. Whenever there is a case 2 where some part of financial statements are audited by other auditor, you need to tell the magnitude. So this is what they have given as per SA 706. Refer the work of other auditor disclosing the magnitude of portion audited by the other auditor, stating the aggregate amounts or percentage of the total assets, revenues and cash flows. So include a other matter para. How to include this other matter para? Please focus. Very easy. We did not audit the financial statement of 8 subsidiaries, which include a total assets of 1500 crore, revenue of 1000 crore, cash flows of 10 crore given in the question. These are audited by other auditor. And then say our opinion for these subsidiaries and joint venture is based on the report of such auditor. And lastly say our opinion. Come on. Our opinion is not modified for the above matter. Clear? Clear, sir. Now the second part of the question was the gap is different. So here they have given that you can take any assumption you want. So whenever the gap is different, you have 2 options. Either the parent management will do the conversion or the component will prepare the financial statement as per the requirement of parent. So they have taken assumption number 1. So what does the assumption 1 says? Subsidiaries which are located outside India, financial statements are prepared as per the accounting principles of the countries. So the holding company management has converted the financial statement to the accounting principles accepted in India. And as a parent company auditor, we have audited the conversion adjustments. As simple as it that? Yes, sir. Very, very simple. So I hope this question is clear. The third part of the case that the auditing standard is different, they have not covered it as a part of the answer. So you can also ignore. So this was a good question. I hope you liked it. Now, sir, after this, come back to your notes. Last 2 topics to go. Take 2 sips of water. Examples of information given in the SFS of any parent or subsidiary, but which is not required in case of CFS. So these are the informations which are required in the SFS, that means separate financial statement, but these are not required in case of CFS. First of all, whatever is the source of bonus share, capitalization of profits, security premium account, you need to mention in the notes to accounts. Unutilized money out of any issue of shares, you need to disclose it as a part of your SFS. And at the same time, you need to mention where is this money invested. Then, sir, MSME disclosures are required. You need to disclose about the imports on CIF, cost, insurance, freight of the raw material, components and spares, capital goods, these need to be disclosed. Then whatever is your expenditure in Forex for services like know-how, technical know-how, these things you need to disclose. Then, sir, whatever raw materials, components you have consumed during the year, you need to mention how much was imported and how much is indigenous. Indigenous means you procured it from India. Then, sir, whatever dividend you sent outside to the foreign countries, mention the number of non-resident shareholder, how many shares they hold. Okay, sir. And, sir, year to which the dividend relates. And lastly, whatever investments that you have made in other companies, you need to give the details about that. So these are the basic things which are disclosed in the SFS but not disclosed in CFS. So, sir, how to remember it? Let's use a fun memory technique. Everyone, please focus on the board. So first of all, you will talk about the shares issue. That is the bonus share issue. Whatever is the source of bonus share issue, you disclose that. Now, when you issue the shares, you get money. Sir, how do we get money out of the bonus share? Shh. It's a memory technique. Just go with the way I am telling you. So there is a money and that money is unutilized. Okay, sir. So you give the disclosure of the unutilized money out of the share issue. Then talk about the foreign payments. Out of the unutilized money, you did some foreign payments. Three types of payments you did: material, services, and whatever was left was given as dividend. So imports of RCC, raw material, components, and capital goods. Okay. Foreign expenditures on royalty, know-how, etc. And whatever was left was given as dividend remitted to the non-resident shareholder. Are these 3 points covered? Yes, sir. And the last point from the raw material, whatever raw material and components consumption you have done, tell how much was imported and how much was indigenous. So these are the 6 points covered. This question was asked in November 22. So if this question is asked in your exam, you can easily score now 5 out of 5. Okay. Okay, sir. And the last topic that is here is management representation or written representation. This is nothing but parents' responsibility for CFS that we have covered in the beginning. Sir, what are parents responsible for? Come on, preparation of CFS. So what were the parent responsibility? Identify the component, get complete and accurate information. Can I just use the information to prepare the CFS? No, you need to do consolidation adjustment. What were the consolidation adjustment? Gap conversion and harmonization of accounting policy. So these are the points which are given. And lastly, we talked about Ind AS 108 and Ind AS 24. So completeness of components included in CFS, consolidation adjustments, permanent and current period, then 108 and Ind AS 24. These were the points we covered in parents' responsibility for CFS. So if you do the question number 1 of your test, your understanding, sir, which question? This question. It clearly asks specific matters of written representation. So these are the 4 matters to consider. Done, sir. Now towards the end, let's do 2 classic questions of ICAI. Question number 14 and question number 15. What does question 14 talk about? Please focus on the board for the concept. There is a company H, which is a holding company following the SLM method for depreciation. Then it has 2 subsidiaries R and S. R follows SLM method, S follows WDV method. So first of all, tell me, whenever there is a concept of depreciation method, is it an accounting policy or an estimate? Sir, it is an accounting estimate. Which Ind AS gives this guidance? Ind AS 8. Okay, sir. Now, sir, can the subsidiaries have a different accounting policy from the parent? No. But can they have a different accounting estimate from the parent? Yes. So this different accounting estimate will work. There is no problem. Now, additionally, they tell that R is not following component based depreciation. Now, this component based depreciation is requirement of Ind AS 16. So if they are not following component based depreciation, they are not following Ind AS 16. This you need to mention in your answer. So see what it says. They say that the facts of the question we have already discussed. Let's discuss the conceptual part first. Any change in the method of depreciation is accounting estimate, not a policy as per Ind AS 8. Whatever is your depreciation method, it should reflect the expected pattern of consumption of future economic benefits. As you are consuming the benefits, you should depreciate the asset. Okay, sir. And it should be applied consistently period from period. There can be different methods of depreciation if the method of consumption of benefits is different. Method for SFS should be same for CFS. It should not be changed. Then write the facts of the case in 1 or 2 lines and then say, adopting the straight line method and not giving effect to component accounting is not in compliance, is a non-compliance of Ind AS 16 or AS 10 PPE. Easy, sir. The starting of the answer you need to start with second option of components gap different. So whenever the components gap is different, we have 2 options. So the second option says component can prepare the financial statement as per the parent's accounting policy using the GAM, that is a group accounting manual. And the parent's auditor will perform the procedure to see whether the group accounting policies are as per the gap applicable to the parent. So just start your answer with this and write the concept we have discussed. Then we covered question number 15. Please tell me, sir, this is a question of de facto control. What is a de facto control? Even without having majority voting power. Even though I don't have majority voting power, still I can control the entity. So if you can control the entity without having majority power, this is called de facto control. So A Limited holds 10% of the voting power and controls the composition of board of director. Now, when you are planning the statutory audit of A Limited, CFS, what are the factors to be considered? So most of the students, when they are doing the question for first time, they can write the answer of planning. What were the points of planning? Understanding the gap, understanding the group structure, understanding the accounting policy, then doing the further audit procedures, then using the work of other auditor and coordination. But if I talk about this answer, for the planning part, they have just written one line. Auditor should make a plan to understand the accounting policy, do the procedures. That's it. That's it. That's it. But the other parts of the answer talk about, first thing, how the entity got the control. So as an auditor, first of all, assess the management's, verify the management's assessment of control. See how A Limited is controlling the composition of board of director. So how do you get to know how they are controlling the board of director? Verify the minutes of the board meeting to see who is taking the decision. Verify the shareholder agreement entered by the parent. Have they provided any technology or know-how which is giving them the control? After you have assessed the control, see the consolidation adjustment, permanent and current period consolidation adjustment. Plan wala thing we have already discussed, and lastly, talk about related party transactions. Okay? Sir, this is an additional point. It was not required, but since ICI has given, we need to consider it. Reporting of transaction with any other related parties given in SA 550. They have given the definition of related party, a person or entity which has a control or significant influence over the reporting entity. Then see whether the related party relations and transactions are properly accounted and disclosed as per Schedule 3 and Ind AS 110. It should have been 24, but it is ICI. We will accept it. Ind AS 110. So these are the points to be considered. So if I give you a short summary, first of all, assess the control, see the board minutes, shareholder agreement, whether they have provided any technology or know-how. Then audit the consolidation adjustments, permanent and current period consolidation adjustment. Then talk about the plan, and lastly talk about SA 550 related party definition and whether the related party transactions and relations are properly accounted, disclosed as per Schedule 3 and Ind AS 110. Awesome, sir. So with this, all the concepts, questions and memory techniques of group audit are done. So lastly, just remember one thing, that you need to push harder than yesterday. You need to work harder than yesterday so that you can get a better tomorrow. So if you want a better tomorrow, work harder, be more disciplined, be more consistent, have that fire within you to achieve more and more. So if you are pushing it harder than yesterday, definitely you are going to have a better tomorrow. So thank you so much everyone. On this positive note, let's wrap up this session. If you liked it, do give it a like. Do let me know in comments how's your feedback, how's your review, because your appreciation is my motivation. See you all in the next session. Till then, keep studying with happiness. Then only we progress. If you liked it, do give it a like. Stay subscribed to the channel for more such videos. Keep going, all of you.